Trading crypto risk on. Your calls, and we end with a look at today's markets. Our first letter is from Gary, who asks, so what happened this weekend? How do you trade these moments of geopolitical chaos? Which opportunities or dislocations should I be looking for? Thanks, Gary.
Well, you want to know something? The good thing is that when, whatever you want to call this, opportunity or dislocation, when it happens on a weekend, by the time you can actually do something, pretty much everything's been figured out price-wise. You know, I was a little confused overnight because they got the S&Ps down 100 at one point, and the only thing I traded yesterday was gold last night when they first opened, and it was kind of fun trading gold because it was all over the place. It was moving like $50 at a crack, and I probably should have traded silver in hindsight, but
Yeah,
you know,
I did a little silver. It was crazy.
I will tell you something. As much as you can get caught up in the news, and it is so hard to distance yourself from kind of what's happening around the world because you don't want to, because you feel dirty almost, you know, like,
Yeah.
you know, you feel dirty trying to distance yourself. But the other side to it is if you try to trade thinking that like this geopolitical situation, like you couldn't have guessed this morning that Microsoft, Netflix, Nvidia, you know, they're all going to be higher this morning. Like impossible to guess. And so I think that the challenge is somehow trying to, you know, I don't want to say distract yourself, but you have to distance yourself from, you know, maybe you take a step back. Maybe you look for things that have gotten too overdone, like I thought gold was overdone last night. I thought silver was overdone. I thought crude oil was overdone. But the problem is, in crude oil, if you looked at the options when they first opened last night, because I did, the markets were $5 wide. Like they were untradeable. So I think that, you know, if we were in serious crash mode this morning, that would be one thing. But S&Ps are down 30. After being down 100 overnight, after opening down 70 and then opening down 70 this morning, you know, we've essentially, you know, rallied back, I don't know, almost 70% of the way. Man, it's really hard. I think you have to trade the tape and not trade the news. That's my cleanest way to say this. You've got to trade the tape, which means you've got to trade what the market's actually doing, and you cannot trade the chaos or the geopolitical fear or news or anything like that. Watch volatility, watch some key things, but you've got to trade the tape and not the news.
Yeah.
So I'm laughing. I'm thinking of Connor Bedard's tweet that you were telling me about after the Olympics, after the gold medal game. He's like, did I miss something?
Right.
And, you know, here it's like, if you had no idea what was going on, you go, oh, Spurs are down 28. What's the big deal?
Right.
They're down 25 right now. They're probably going to be up in about, you know, 3 more ticks. So but to say trade the tape is how do you, because clearly buying them when they were down 100 would have been an unbelievable trade. Selling silver when it was up, you know, traded 97.5 gold when it was higher. Those are obviously, in hindsight, those are easy, but when it's happening,
it's impossible. I understand.
Because you're looking at this, and again, we're looking at volatility, so it's coming in a little bit, but the future /VX is still up 70 cents, and VIX cash is still up $1.66. Those are still both big moves.
Yeah.
So the market is not saying that this is over. The market is saying, hey, okay, there's a little bit of fear. Market doesn't like fear. There's a little bit of fear, but not so much fear because we're down, you know, S&Ps are down 0.34%. Who cares? That's not, you know, we're still within striking distance.
It's just another Monday.
What's that?
It's just another Monday.
Yeah, it's just another Monday. So, you know, we'll see what happens over the coming days and weeks. And if this winds up turning into something, you know, far more significant than I think what we're being told it's going to be, you know, maybe it's a different response. But right now, doesn't really look like the market cares what's happening. Even with oil, you know, oil's up $4. That's a big move. It was up 7, I think.
When it opened, but then immediately was up 5. Like it sold up $2.
But still, that's a big move.
Yeah,
But even with oil up here and the fear, the concern that if they shut down Strait of Hormuz and then all of a sudden we've got oil, getting oil to us, as issues, is it really going to be a massive impact? Is it going to be a drag on the economy? Is it going to cause inflation? I don't know. I think it's going to take, if that happens, it's going to have to be for an extended period of time, not for, 24 or 48 hours. So I agree with you. Got to look at what's in front of you as opposed to what's around us. And right now, what's in front of us says not much to fear here.
Our friend in the dog pound says this might be the quiet before the storm.
And it
What
could
do you
be.
think?
I mean,
it could be,
It could be,
right?
but that's just as.
That's another guess, too.
That's just as nutty a guess as anything else.
50-50.
Can I say one thing about, since you brought it up, you opened the door, counselor. Connor Bedard has the best wrist shot I've ever seen in my life, of any player I've ever seen. And the fact that he didn't make the Canadian team, they should be embarrassed, because they needed a sniper, and he's a freaking sniper. That kid is the best wrist shot I've ever seen.
Well, excuse me. But apparently Sidney Crosby didn't want him on the team for some reason. I mean, I don't know who was in that, like who we would have taken the spot.
But
what's that?
Apparently, but he has the best wrist
They
shot.
missed out is what you're saying.
Yes.
Okay.
It's unbelievable how good he is.
Also, the dog pound is asking, Maria is asking if Sol is trading yet. And if so, what? Not yet. I need to get my stuff together. I'm only invested. I'm not trading yet. But I will start because I'm getting the itch. So hopefully soon. I will definitely let you know.
I can't handle it. Don't, Maria. It's not a good thing. Don't let her start. It's not going to work for us.
Oh, we'll see.
No,
Why not?
because I don't want you trading. I just think
Oh my God.
No.
Oh, because you want me working.
investing. Yes.
No, because
9 to
if
9.
if something goes awry for you on a trade, it's going to be the end.
I don't think I'm going to have a whole lot of risk anyway, so it's fine. We'll see. No, it won't be the end. Maybe. We'll see. All right,
I can't
anyway.
handle it. I can't handle it.
All right. Well, next up says, I'm always confused about when to recenter a trade. Buying the guts and selling the wings always confuses me.
It confuses a lot of people, and buying the guts and selling the wings is something that we kind of coined, years ago at Tasty. Essentially, what it means is this: it's the art of recentering. So, for example, when you short a strangle, let's just say you sold a strangle here, you sell the calls up here, you sell the puts down here, and then you're making a bunch of adjustments over the course of a month. So then you end up, you started here, now you end up here with still some time left. So now you have a lot more risk and you don't really like it as much. So what you do is you just buy these that's the guts. You buy the guts back and you sell new wings and you recenter. And in the old days, you couldn't really do that because the markets were too wide and it wasn't cost efficient. But today, because everything is so priced around theoretical that you basically give up a penny or 2 pennies to theoretical to do all 4 legs, and it's super cheap to recenter. So buying the guts, selling the wings, do it anytime you want, same month, recenter your trade. I do it all day long. I mean, I already did it today in natural gas. What else did I do it in? I already did it in natural gas, silver, AMD, and IWM. So I think I've already done it in 4 or 5 different underlyings this morning in the first 15 minutes of the day. Piece of cake.
Okay. Any other words, Scott?
No, I like it.
Scott's
Great.
not a by the guts recenter type of guy.
Not really in my DNA, but I get the
Okay.
concept.
Okay.
Yeah.
All right. So Keone in the dog pound says the Netherlands will be taxing unrealized gains in trading accounts greater than 1,000 starting in 28. Sounds like a recipe for even more disaster in that country. Thoughts?
100%.
So
100%
taxing-
disaster.
100% disaster. Now, here's something that I talk about all the freaking time. And the Netherlands, it's a really big deal because the Netherlands is a country that has a lot of financial firms and a lot of financial firms that actually do quite well in the United States and a lot of financial firms that have moved out of the Netherlands to the United States. That said, let's take it back to a discussion that I've had 1,000 times, and I stand on an island by myself on this one. but I have long argued that the problem with trying to police politicians is that you are trying to police people that don't know anything about the business that you're in. And therefore, the most important thing to allow politicians to do is to trade, is to get involved in the financial markets, to learn market structure, to learn what trading is all about, to learn how finance actually works. And which goes all the way down to capital raising, which goes down to so many different levels of what really builds an economy. If politicians understood how markets work, they never would be taxing unrealized gains. Unfortunately, because politicians don't know how markets work, you end up in a situation where you have some governments that decide to do incredibly stupid things like tax unrealized gains, which basically shuts down all trading, investing, everything. I mean, it's just absolutely horrible. It forces money, it just disappears from your country. There could be nothing dumber than that. And the way to get around it is you let everybody participate in the market so they learn the markets.
Yeah.
But
And
their answer is going to be, because I'm assuming that this decision, if they actually are doing this, is being made for revenue. So, they're saying, why should we let people have positions on that they're up money on, not tax it? The problem, a lot of problems. And I don't think, I agree with Tom, if these people were trading and they were actively engaged, they would realize how ridiculous it is. I'm not sure if they still wouldn't do it. But this, to me, first of all, you have a gain, you get taxed on it, and then it turns into a scratch or a loser. You can't get the tax back. They're gonna, well, at least I don't think so here. You're limited as to what you can file, for a loss carry forward every year. So complete disaster. Think about it if you don't understand what this
Well, I don't know if
concept
they have loss carry forwards, but it doesn't matter. It's
But
just a
think
disaster.
about it. If somebody was selling widgets, that's all they're doing. They're selling widgets. And think about if the government went in and said, we're taxing you on 100% of the widgets you have because you may sell those at some point in time. It's the same thing.
Think about how hard it is
Right.
to just figure out what something's worth. Everybody's going to do everything in markets where they can't mark to market anyway. So,
Well, they'll figure out how to mark to market, but that could be even
but that's
worse.
even
They-
more troubling.
it's been discussed here, not
No,
talking
this hasn't
about-
really been discussed.
not talking about taxing, unearned or open positions, but putting taxes on, for example, futures. Like that was a big talk like 15 years ago. We're going to tax, I don't know, some silly number on futures trades, which would have basically made trading futures, it would have been over. It would have made it cost prohibitive. So
Well-
I'm agreeing with Tom that if you had the people who are making these decisions more actively engaged, they would realize how silly the idea is, and they need to find another way to come up with revenue, period.
They're going to. We're doing a Unleashed this week. It's called Buy, Borrow, Die, and you're going to like it because Buy, Borrow, Die is essentially this. It's buy some stock that may, for the next 20 years that you think, or some index, borrow against it, and then hope you die before you pay the taxes.
Well, this is what they're calling a rich people technique.
A high-class problem.
But-
But my point is, it's what these guys are trying to avoid. It's what these guys are trying to tax. It
Yeah.
doesn't. It's so ridiculous.
But there's still tax if you die. There's still tax. I mean, depending on how you protected your money, you're still paying a death tax if you're over a certain number. So, that still exists. Just the fact
yeah,
of
but there's
taxing-
it's we're talking about underneath. I think it's like
Whoa.
the $10 or $20 million, whatever it is.
Get
now.
into that
Yeah.
discussion.
Yeah, I don't want to get into the discussion today, but we are doing a piece called "Buy, Borrow, Die,"
Yeah. Yeah, we are.
just to address this one topic.
Yes. Okay. Next up.
Yeah, but don't be shy also about calling in.
That's right. 989 Lost Dog.
Yeah, and we're in day 5 or day 6 of our. Tomorrow will be 1 week since we launched our offer with free crypto, $1 million of free crypto. Go to Lossdog.com and sign up and get yours, or get in line. And we want to give it all away. So the offer's been going great. So keep playing
Yeah.
along.
And send your referrals. Okay. Have any of you been active with crypto liquidity pools? What's your thoughts on these? What's been your takeaway with them? This would be an important part of a Lost Dog stablecoin, right?
No. No, that wouldn't be fair. So we're not. Okay, so the only crypto liquidity pool that we've dealt with in the past, me personally, is just spending a lot of time on Uniswap, which I think is pretty poorly designed, but that's the only crypto liquidity pool that I've ever played around with. We have built technology building liquidity pools, which is kind of cool. We never were able to launch it because we couldn't find somebody to clear it. That's one of the last exchanges we built, was a liquidity pool based exchange. And so we have spent, I don't know, hundreds, thousands of hours working on liquidity pools. So I'm fascinated with the concept of liquidity pools for retail investors. We wanted to be the first, but it just didn't work out that way. So my takeaway with liquidity pools is that they're super interesting and everybody should understand them and this and that and all that kind of stuff. But the stablecoin, the Lossdog stablecoin, is not based on liquidity pool concept. A stablecoin is kind of a risk-free, like cash-like asset.
The dollar substitute.
Yeah, it's a digital dollar substitute. So we're not really, that's not part of a crypto liquidity pool or a digital liquidity pool. A crypto liquidity pool would be like Uniswap, where you're just swapping, for example, Bitcoin for ETH, or you're making a market around the Bitcoin for ETH swap market. That's a crypto liquidity pool, and you're providing liquidity, meaning you're providing capital and or product into those markets. That's what providing liquidity is. The liquidity pool we were building was just for futures and futures options. And listen, interesting, huge opportunity, interesting concept. Hard to find exchanges that are capable of clearing that right now.
Okay.
But I love the question. If we found a way to do it, we would do it.
Okay, let's take a call. We have Satya from New York.
From parts unknown.
Hello. Are you there?
Hello?
Hi.
Yes. Hello, hi. Wow,
Hey.
I didn't think I'd get picked. That's so nice.
That's okay. We got like 3 lines open today, so it's a Monday. It's perfect timing. How's it going?
It's going fantastic. So I am a master's student at Cornell, studying in NYC, and I'm building this company called the Mind Over Market. And I've been trading for a while now. I'm not an expert yet, and I'm originally from India, so I couldn't trade from the time I came into the U.S. All my funds are holded up on a deck somewhere. But the real question, what I have for you is, I'm trying to build something AI native that can help discretionary traders reduce emotional like drawdowns which come from emotional trading. How big is the problem? How do I approach this? How do I get into a design partnership with some firms, given that you've built big successful terminals before?
So there are a bunch of platforms out there that are trying to tackle the same, like kind of the same issue. I'm actually just a recent investor in one of them. So I mean, later on I can give you more information, but there and a lot of really smart young people like you. The group I'm working with is from a different institution, but we also, Scott and I work with a bunch of young traders from Cornell that built, high frequency trading technology. So we're very familiar. I would say that, don't try to, my words of advice to you would be, don't try to solve what you think may be a specific problem. Build what you really want to see. Like you're curious about, you're worried about the way, people make decisions and the way, I'm assuming, the way people deal with, what do you do when things go bad, or, what do you do when a position goes against you, right? Like, how do you make an adjustment, all this kind of stuff. I mean, we've been dealing with it very mechanically over the last, 15, 25 years. And so we have this whole set of mechanics but if you're talking about using some form of agentic AI or whatever to.
No, not really.
Okay.
I think that's where most people screw up, is when they get agentic AI and it starts making decisions for you. And I
Okay.
don't want that on any trader. The trader has to have full discretionary. But
Okay.
you use something like a finite state machine, which is Turing and complete, to understand the intent of a particular strategy. So, and then use Markov decision chains or processes that then give you this probability of you violating a rule and starts adding friction. But still, it's all, deterministic in a natively
So
stochastic
that's exactly what
environment.
you should build then. You should build it, it's software based. It's software based rules. It's a set of mechanics. And you should just, the challenge for you is going to be figuring out those mechanics. I mean, over the last, 15 years, we've done a ton of research and built a set of mechanics around that exactly. If you haven't read Julia Spina's book, you should get a copy of The Unlucky Investor's Guide to Trading Options. She has, in that book, she outlines all of our mechanics almost from from day one. And you can see they're all adjusting mechanics.
Right.
But again, that's where I would start. And assuming you're going to do the coding and all that work yourself, I mean, that's where I'd start. You have a lot of challenges ahead of you, but as long as you can do your own coding and as long as you can build that up, logic-wise.
Oh yeah,
I mean, see what you got.
We're three co-founders. I do the math and ML. I have two they're all full stack, and actually we're out headed into to have a meeting with Apex. Actually, I don't know if it's a good thing or a bad thing.
It could be a good thing. I mean, we've cleared there for many years, and they're really good guys. And I mean, we're friends with everybody there. So,
Right.
I mean, all I can say is they're a great firm, and we have had a long, 25-year relationship with them at least. So,
Right.
they're real. So
I think from what's out
Good
there,
luck.
they're going to be your best chance, your best shot at an accommodating clearing firm.
Yep.
So yeah, I think you've landed in the right spot. If
Fingers
you can figure out
crossed,
how to-
and good luck to you.
yeah.
Thank
Good
you.
luck.
If I
Stay
had
in
to
touch.
reach
Let
out
us know
to
how it's
you
going.
in the future, what could be a way?
You can send me an email, just Tom at Lossdog.
Tom at Lossdog. Thank you
Yep.
so much.
Okay, take care. Good luck.
Thanks,
Good
Satya.
luck.
Thank you.
All right, we have our calls to get to. So
3 lines open, so fire away.
I think we missed Steve. Oh, we do have Steve from Miami. Steve?
Miami.
Hi, guys.
Hey, Steve,
Welcome
what's
to
up?
Miami.
Good morning.
Hi, good morning.
All right. Good morning. Okay, first I just want to say, I think I mentioned before, I do like the format of the show. It's kind of like what you did at Tasty, but expanding on it, Tom, with all the shows you did over there. So it's like you're not constricted. And then, by having Scott, with you there, it's kind of like I like times when you agree, when you disagree, so that broadens it out. So, that's excellent. And, the balance that Sol provides is
Thank
very,
you.
very helpful. So I just want to say, really enjoying the show.
Good,
Thank
good.
you.
Oh, on that note, by the way, does that help me move up in the line on the crypto?
Oh,
No,
So
but we
it might-
appreciate it.
If you say nice things about Soul, she might just,
no.
Okay.
Sorry. No.
Take what I get. No, but
you can,
I'm
you can
sincere with
send your
all of that.
referral link, and then that will definitely move you up.
I mean, what if he sends you a
I
check?
have been.
No.
I have been, by
I
the way.
can't be bought.
I've been sending it. You can't be bought. Well, good for
cool.
you. See, that's why I like you. Okay, so I had my question written on my computer, and it disappeared. But I know it was this. The other day, Tom, you mentioned your preferred strategy for zero DTE, and you said you go one standard deviation, I believe you said, or the expected move for the zero DTE, and then you buy $20 out on the wings, and you either do it the same day or the following week or the
Right.
following month. And my
Right.
question is, first question is, what's the pros and cons? How do you decide? What are the pros and cons in doing it the same day, the next week,
Okay,
etc.?
so my preference is, generally, my preference is the same day because it's just easier. And there's less of a bid-ask differential. But the pros of going out further in time is just that the premium doesn't decay. So if you like to do this every day, sometimes people like to think that they can keep those back month options and just wait till the next day and use them. I find that actually becomes expensive for the second half of the day that they're wasting away in premium. So my preference is to use it all in the same day, or if you use the back month as your defined risk, to get out of those the same time you take the trade off. So either way, I like to get out of the whole trade the same day.
Okay, so wow, but yeah, so when you mention that, you're saying that in a sense, if I, for instance, got out of the trade, let's say the short wings on the same day, but I left the further ones out, I can kind of use them again for the next day.
You could, but I don't like it that much.
You have decay working against you if you do that.
The second half of the day.
Yeah, so you got to be careful. You absolutely can do that, Steve, but just be careful because your long premium that's worthless, because it's you're buying way out of the money. So it's going to start to evaporate. So you just need to be careful if you're doing this strategy, like Tom said, either get out at the same time or, your choice is just to be aware. Either you could put it on the next day. So if you're doing SPX, for example, you could take off today, you could start doing tomorrow, but most people want to wait till 0 DTE to see where the market's going to be the next day. So just be aware that there will be some additional decay on the longs.
Yeah. Hey,
so then what's the advantage then of doing it, as you said, a week later, a month? So what?
Yeah, I just think I need to clarify something. When I do it a month later in time, I don't do it 20 points out. I do it at the expected move a month later, just because I should have explained it better. If you're doing it the same day, the next day, or a week out, I go 20 points wide. But if I'm going out a month in time, which I do a lot, I will go to the expected move 1 month out. So the expected move for a month, let's just say it's 100 points. So I'll go 100 points out, and then the front month will be just at the expected move for that day. I just use all the numbers on your screen. It's really important to use just all the mechanical numbers that are on your screen. So whether it's 1 day expected move or 1 month expected move, those are the numbers I use. It keeps you really consistent.
Although that makes it a much bigger risk in a sense, doesn't it?
Not a bigger risk. It's not really a bigger risk, but it means you're going to put up a lot more money.
Okay.
So when you buy the wings a month out, you're going to be paying a debit for that trade. When you buy the when you do it in the same day, it's a big credit.
I see. Okay. So it is a little tricky, though. It's really very strategic. Then you have to decide
try
what
both.
strategy.
Just try both. Try with one lots. Try both and see what you like.
Okay. So what more am I risking, though? Like, say, if I do the 100,
nothing. You're not risking anything more. The results are going to be virtually the same.
Even though it's a much wider wing.
Yep. The results are going to be almost exact. You don't have to worry about. Don't worry about one is a lot more risk than the other. They're almost. The difference between the two is going to be minimal. It's going to be almost nothing. The focus should be on which is more comfortable for you. You're going to make the same amount of money.
Why it's not more risky? Can you? Because the first day is. Yeah, go ahead.
It's not more risky because you're doing everything wrapped around theoretical value. It's just not more risky. You're still short the front month and you're long the back month in either case, and they're going to decay virtually the same. It's the same trade.
The front month is going to be a lot less expensive, but it's going to decay. Obviously, it's got to go to 0 because it's that day.
Right.
No, I know, but I'm just saying there's no more risk in either of those two trades, whether you use the 1 day, the 1 week, or the 1 month. And you go out to the expected move on both, the risk is going to be exactly the same, Steve. I know it sounds a little weird, but the risk is going to be the same. So try them and see which one you like.
And expected move is the one standard deviation, that dotted line. Is that yes or no?
That's right. Yep.
Okay. Yep. Then finally, the other day when you were talking about this, you were saying it didn't work today. But we were still in the middle of the day, or in the morning, actually. Did you mean it's not working at the moment? Or did it not work?
No, it didn't work at that moment. I don't know what's going on. I meant it didn't work today, meaning we're doing the show. At that point, it didn't work.
Yeah, but it's also, I think we had moved like 60. We
moved almost 100 handles that morning.
Yeah,
it didn't work.
Way outside the expected move. So, Steve, the question, I think the comment that Tom's making is it didn't work. Chances are, if you sell something expecting a 30, it's expecting a 30 or 40 point move, and we move 100, you've got to do something.
Yeah, listen. You know what? Steve, it might have
okay.
worked by the end of the day, but I mean, you can't take that chance of whatever. You know, it's the zero DT trade is an hour or 2 hour trade, and you're shooting for
Right.
20, 25%. I mean, that's really your target: 15, 20, 25%, maybe 30 max. So in the
understand.
first hour, if you move 100 points on a $30 expected move, the trade didn't work. That's all I was saying.
So did you close it? Did you close it, or did you move your other
No, I didn't
the
have a
untested
zero.
side?
I didn't have a zero DT on that day because I had other trades on that day, but I didn't have a zero on the
I think
day that
somebody
you were talking.
asked the question.
Yeah, somebody
about
asked
it,
the
and that's
question.
what Tom said it didn't work
I
because
see.
we had moved
Yeah.
so much.
I didn't have that trade on
Gotcha.
that day. Yeah.
Got you. Okay.
All right, man. We
All
got to
right.
jump, Steve. Thanks.
Thanks,
Thank
dude.
you.
Bye.
We're
Thank
going to go
you
to
both.
our
Thank you all.
buddy. Bye. Bye, Steve. We're going to go to our buddy Tyler in Chapel Hill. Hi.
Hey guys,
How are you?
Hey, Tyler, what's up?
good. How are you?
Good.
Hey, so I had a question. I have about probably $10,000 of cash from all of high school saving up, and I have
Good
a
for
little bit of
you.
investing experience. So it's I probably invested $1,000, and then it's at 1,400, but that was higher risk trading.
Okay.
So I was just wondering what you guys think is the best to do with that $10,000 that I have, so I just don't have it just sitting around.
You're saying from a trading standpoint?
Or from
you
an
wanna get
investing
active?
standpoint.
Just from any standpoint. I was just saying I have a little bit of trading experience, but it was higher risk, and I don't want to spend all my life savings on, but I'm still young, so I mean, it wasn't incredibly high risk.
Right. How old are you?
I'm
He's
18.
in college.
Oh, 18. Perfect.
Good for you. You got $10,000
I
at 18.
know. Good for you.
Yeah. Go to Vegas and get some
No,
hookers.
stop it.
Okay.
No. No.
Now we're talking.
No.
I like where this is going.
Drugs. I mean, you can say a lot.
No.
Okay, this is clearly not the family section of the show.
Okay.
Tyler, it depends on what you're trying to do. And I'm not trying to be funny when I say that. Do you want to put the money at risk, or do you want to keep it safe? Do you want to blend? If you want to blend, you could go buy, we talked about SGov or a BIL, as cash,
He's 18
doing something.
freaking years old. He doesn't want treasuries.
Well, I'm saying if you want, because he's I don't want to
He
risk
wants
it. So
balance.
I don't know.
The kid
If you're
wants to get ahead in
asking-
life,
No,
okay?
yes, but he wants balance at the same time.
All right, Tyler,
Tyler,
don't listen.
how
to
much
these-
risk do you want to
Don't
take?
listen to these old
You are
Dukakis.
sending him to Vegas.
Okay, listen.
And
Get
Scott
hookers
is
and drugs.
proposing
And that
a
is- that-
balanced.
that put the whole thing on black, right?
Try no, I wouldn't do that. But you got to try some stuff. You got to learn to take some risk, and you got to learn to just
Small.
I mean, buy some stocks and companies you like. Buy some,
Small.
who knows? Buy some quantum stocks. Buy some precious metal stocks. I don't care what. Buy some tech stocks or small caps. It doesn't make any difference. Just spread the wealth around for a couple $1,000s. A couple
And
other.
Tyler, I'm assuming when Tom's saying that, I'm assuming you're aware that you could buy fractionals. You don't need to buy 100 shares or a full share. I'm sorry, not 100 shares, a full share.
Forget fractionals. Just
You can buy fractionals.
Let him try.
You got to get off this fractional
You're
kick.
always saying try small.
Hey,
Do
just
small.
just make some investments
And often.
and make a bunch of investments. Use a couple $1,000 with the remaining amount of money. Spend a little bit learning how to trade. Use some trading strategies. Maybe try some event-based contracts. Try some different stuff that involves a lot of or a reasonable amount of risk, especially short-term risk and stuff. Because when you're 18 years old, you can afford to take chances that you can't afford to take when you're 50 or 60, and you're going to learn a ton. Have you already committed to a certain school?
Yeah, I'm at Chapel Hill right now.
What
Okay,
do
so
you
you're
mean?
a freshman.
He's at Chapel Hill.
Well, I don't. He might live in Chapel Hill.
No.
Oh, so you're a freshman at UNC.
Yes.
Yes, sir.
Okay.
Yes.
Perfect. So figure out what you like, and they have a ton of really good investment clubs there. And
Maybe you can start one.
I think they have a trading club too, but I know they have investment clubs at Chapel Hill. You should get involved in some stuff, see if you really like it, and especially on the trading side, try everything. You can risk a tiny little bit of money. Try everything that's out there. Now you can do everything, on various different apps, and see what you like, because that will have a big impact on what career path you take and what classes you take. I mean, maybe you're like, hey, I like financial markets. Maybe I do financial engineering, or maybe
Right.
I like entrepreneurship better, so I go the entrepreneurship route in business. Like, I have no idea what you're studying, but that's the way I would approach this. Throw as much crap against the wall as you can, see what sticks in the investment world, and then make some, longer term, more passive bets, as well as, a lot of short term things to see what you really like. You're 18 years old. You're not putting away money for when you're 60.
Yeah.
And buy some crypto. Buy a little.
Well, he's going to get some crypto.
Well, buy a little digital assets.
From us, because he signed up.
Everything, dude. Try everything.
Okay, I really appreciate that.
All right, man. Thanks.
All right, thanks for
All
calling.
right, guys.
Thanks,
you.
Tyler.
Yep,
Bye,
have a great day.
Tyler. Let's go to Daniel in San Francisco. Hi, Daniel.
Hey, so hi guys.
Hey,
I
Daniel.
had a trading question.
Fire away.
I've been trading silver. I'm now in after a bunch of rolls. I'm in an SLV inverted strangle, short the 101 call, short the 119 put, 18 days DTE. It's only got like $170 in the extrinsic left. I've collected probably $1,000 in credit.
Okay.
But volatility is so high. It's taking so long for some of the juice or to see anything come out of it.
Yeah.
Would you recommend still rolling and then just waiting until eventually IV might start to flatten out?
Hold on a second.
Kind of
I think you got to recenter that trade.
Hold. You're in SLV.
Yeah.
Where's SLV trading right now?
it's at
SLV is
81 $81. Yeah,
81 bucks, and you're in the
twisted. I'm totally twisted. Yeah.
Yeah. What are you doing there? That position makes no sense. You're short. What's the put you're short? The 117.
119. So I was rolling the strangle up all the way.
I got it. I
at
understand.
the top.
I understand. Yeah, but now those calls, I know they have a little bit of premium left in those calls, but 18 days left, and you're short with the 101s or something.
Yeah, short the 101 call, short the 119 put. Inverted.
Yeah, I mean, to be fair, you're in March, right?
I'm in March.
Yeah.
March 20th. So the March puts are 37.5.
Yeah.
And the calls are $1.50.
Yeah.
So
Here's
you
gotta buy the guts back. This is what we just talked about earlier. You gotta buy the guts. You gotta buy that trade back, and just recenter it with. You can still give yourself some upside delta, which is what you have right now. You need a rally, and so you can give yourself some upside. But I would recenter it, just as an example. I would recenter it in April, because you pick up that extra month worth of premium, and do let's say the 75-105. And if you did that, you're going to pay a little bit of money, but at least you can make some money. Like right now, you can make like $1. The most you can make is like $1.70.
You can make about $2.
All right, $2, whatever. So you can make $2 max, but you're taking a shitload of risk to make $2. If you recenter in April, all right, for which isn't easy to do. It's a single click. Just buy back your short strangle and sell the April, because the volatility is still so high in there. Sell the April 75, let's say 105. That gives you kind of a nice, wide, normal strangle. I mean, then you can make back, whatever it is, like $8 or something like that, or $7. And you need to make that back because you're down a lot of money on that trade.
Yeah.
I mean, you can't, the trade you have on now makes no sense because you can't make any money on it.
Unless you're just ragingly bullish.
Yeah, unless you think silver's going back to the moon.
Right. If you think silver's going back to 119, then you have a really good trade.
Yeah. But
my break even is at 92 with all the rolls right now.
Oh, okay. So that's not that bad. So it's better than I thought.
Yeah.
So I would roll. So I would do like that 75, 105, or if you want to keep some even more upside, 77, 107, something like that. But just do it $30 wide, and move it to April. And move it to April right now, because today there's a ton of vol in there today, and I mean it's come down a little bit, but that's what I would do. Having the position you have on now makes no sense.
Okay, all right, thanks. And then I do have one quick question too.
Sure.
In your experience, what's like the account size that you guys really see like customers having some more success with? Trading tasty bite size.
Yeah,
I'm sure.
I mean, you want to be
tough. Is there?
Yeah, it's tough. You want to be absolute minimum would be like 25-ish. I think 50 to 150 is a good number.
Okay. All right.
I think
that was
when
the other
you're
question.
I think when you're under 50 or under 25, you run into capital issues all the time. I think when you're between 50 and 150, you kind of get over that. I mean, the best place to be is like, 200 and up, but I think 50 to 150 is a really good number for, self-directed investors.
Okay. All right. And that was the case for my experience too, but I'd have to take money out for certain things. So I was just kind of.
I know sometimes
wondering,
life gets in the way really well, like almost 90%. When I shoot for anything more, I'm not even positive.
Cool. All right, next up. Are there any specific screens, scans, or mental shortcuts you use to spot high probability premium selling opportunities quickly?
You wait till Scott posts his trades on the
Oh,
platform,
God.
and then
Here we go. Here we go.
wait till it goes against them for a couple of days, and then just sell them. Other than the Scott Sheridan approach, well, there is the fastest, easiest way to do it. It depends what platform you're on. I mean, since the last platform we built and used for the last 15 years was Tasty, I would say that on Tasty they have a market, they have a watch list tool in the center section, and if you go to it, you can set your screen up so you can choose as one of the watch lists high option volume, and then from high option volume you can choose IVR, which is your third column over, and then when you go to IVR, if you click on it, you can go to on the title, you can click it, you get ascending or descending order, and so if you go to descending, you can have 100, everything that has the highest IVR from 100 all the way down, and with the highest option volume, that is the easiest way to search. Tony and I
So
would
right
use,
now I'm doing it high option volume.
Yep.
And then by IVR. So
Yep.
stocks that I'm not, for the most part, some of these I'm not familiar with, but OWL it's a $10 stock.
Yeah,
but
that's
it's-
Blue Owl. That's the one that everybody's freaking out over.
Correct. GLW, EWE, Oracle, USO,
Yep.
CORZ, LMT, MU, SLV.
Yep.
So it's really simple
It's
to
the
look
best way to do it on any platform. It's super simple. The devs did a really good job with that mechanism.
Yep.
Did you have
And
any
if
papers?
again, it's a starting point. So it gives you ideas to say, I don't know where to look. I don't know where to begin. It's a really good question because I think most, especially beginners, they say, I don't know where I'm supposed to go to begin. I know what they're saying makes sense. I understand it, or I think I understand it, but what do I do? This is Tom just laid out for you. Again, I'm just searching on the Tasty platform.
It's super simple.
Yep. It's right there for you, and then you can go look at something like, let's say, Oracle or USO or
Feature.
Okay. Okay. All right, next up. I'm new at trading options. So far, I've put my toe in the water, selling covered calls and buying some long-dated calls. So far, so good. Now, 2 questions. What would be the next logical options strategy for someone new and who is willing to take modest risk? And then second, is there ever a mechanical reason to exercise options that go in the money?
Okay. The first one, I would suggest you start looking to sell premium, which you did if you're selling a covered call that is selling premium. But buying some long dated calls, that's buying premium. Our approach is going to be to sell out of the money because it's a higher probability of success. Obviously, there's more risk.
I think
to
they're
it.
doing a poor man's covered call, Scott.
Oh, you think that's what they're doing? here?
Yes.
Got it. Sorry, I apologize.
Which
Okay.
is just buying long dated options and selling the call against them.
Got it. That's a long one. Fine. So you're doing a covered call.
Yeah.
Fine. So what I would do is I would look, and if you're directional, because this is what you're doing, a poor man's covered call, that is a directional trade. You're looking for the stock to go higher. You
Right.
could consider, instead of doing that, you consider selling a put spread, just slightly below the market. If you think the stock is going to be going up, if you think the stock's been going down, you could consider selling a call spread. If you think it's going to be staying in the middle, try an iron condor. But I would try selling some other premium other than doing the the covered call. I think that would be a nice next step. From my viewpoint, there is never a mechanical reason to exercise options that go in the money.
I agree with him. There's never a mechanical reason to exercise options that go in the money. There's never a
Okay.
mechanical reason. And same thing on the put side. I mean, same thing for this question number one. The next logical strategy for what you're doing is to sell a put or sell a put spread to give you kind of a very similar risk profile as a poor man's covered call or a covered call, but it's just the next logical step. You'll learn a lot from just doing that.
Got it.
It'll
Okay.
expand your universe of strategies.
Cool. Next up, what should I do about choosing the correct options expiration series if my trades are only going to be 1 to 5 days in duration?
Ooh, this is a question that.
So wait a minute. Let me make sure I understand this because there's probably more to this email. So they don't want to trade, if they are available, the weeklies, knowing they're going to take them off in 1 to 5 days. Correct. So they're looking like, do I go out
Right.
21 days?
Their trade duration tends to be 1 to 5 days, but what expiration series should they do if they're thinking 1 to 5 days?
Do they say long or short?
Nope.
Okay.
I tell you what my answer was to this person. My answer was that for consistency reasons, I would use the monthlies. And I say that because you could use the weeklies if you want to, but sometimes with the weeklies, you don't have the same amount of liquidity. It depends what you're trading, because they didn't say what they were trading. But if you're trading obviously a very liquid S&P ETF or something, you can use the weeklies if you want to. But for consistency reasons, and so you don't get caught up with positions and all these different expirations and forget what you have on and all this other stuff, just use the monthlies. It doesn't matter if your trades are 1 to 5 days in duration. It could be, who cares? I think that for consistency reasons, I do this all the time. My trades are 1 to 5 days in duration, and I trade the monthlies. So I just went with what I do.
Okay.
Okay. Next up, I mostly trade options on index futures. I just closed an iron condor for my original target profit, but it was relatively early in the expiration cycle. Would it be risky to open a new iron condor on the next monthly contract, or is there a better window to wait for?
Yeah, this is called redeployment. A lot of people question, I just made a winning trade.
Right.
Now what? Should I go party, or should I take the
Go to
rest of the
Vegas,
day off, go to
or
Vegas,
Invest.
take the weekend off, or should I reload? Should I even reload in the same underlying? Should I reload in a different underlying? It's a very typical question for a lot of traders. Sometimes I'll reload in the same underlying right away. This, they say, is index futures, but sometimes I'll reload immediately, and sometimes I'll wait. The way the numbers work, you have to reload, but sometimes it doesn't make sense necessarily. If IVR is high, I'll reload. If IVR is low, I
But
might
in
wait.
the same cycle, or are you saying to go out further?
I might do the same cycle. I might do the same cycle. It just depends how many days. Like it's just a trade. Okay, so I'm not in love with it. It worked. Maybe I just do different strikes. Maybe I do a slightly different underlying. Maybe I use the next month out. I don't really know. But the key to this game is to always be in it. You have to play the game. So you have to redeploy. Whether or not there's a better window, man, I wish I knew that answer. Yeah, I wish I knew the answer.
Okay.
This is something every trader battles with this. I mean, we really do. Nothing's easy about this.
Right. Okay, the poll closed with 58% who have not traded 0DTE.
Yeah.
Okay, I can understand. I can accept that
Yep.
All right.
reluctantly.
Reluctantly. All right. Well, next up, I use an SPX put selling strategy that has become my main bread and butter, that should be, trade. Or butter and butter trade.
Better and better trade.
Better and better. How much BP reserve should I maintain for market downturns, and how much powder should I keep dry to take advantage of high IV to place other trades?
Who wrote all these? These are hard questions today.
These are
What's
hard
everybody?
questions. I mean, this is really tough. This is really tough because
They're
if
coming
it's their
for you.
bread and butter, then obviously it's been a great trade,
Right.
because we've been going up for the last 20 years. That's not the hard part. that's easy. Just keep doing it if it's working. The hard part is on a day like today, when I don't know where their what puts they were short. So if they were at, I assume they were further away than whatever, however far we were down. But vol was up this morning and the market was down big. So the question is, are you forced to do something? Hopefully they're far enough out of the money. Keeping powder dry, Tom, you're going to give better numbers, more accurate numbers on this, but something like for me on the SPX, you obviously want to deploy a lot of your capital because if it's working, you're making more money, but then you have so much more risk on the downside. I would think you don't want more than 25 to 35% of your money at risk to save money for something to happen. If you went to 50%, okay, but I would not go anything over that, but I would stay smaller.
That's fair. Listen, it depends where implied volatility is. And right now, with the VIX at 2167, you could have as much, anytime the VIX gets over 17 and a half, 18, in that 20 range, you can be up, depending on account size. And obviously, the smaller the account, the higher the allocation, the bigger the account, the smaller the allocation. But normally, we'd like you to keep about, 40 to 50% of your powder dry. In this case now, you could be at that, 35, 40%, just because the VIX is high enough that it warrants additional capital in the markets. But generally speaking, you don't want to, that 60% buying power usage is usually pretty good. I'm usually, with a slightly larger account, I'm usually in the neighborhood of, using about 40% of my capital. And I think for smaller accounts, they could be up to 70%. So it's somewhere between, with the market with VIX at these levels at around 21, I'm usually at around 40%, and smaller accounts could be 65 or 70%. When the VIX is a little bit lower, I'm usually around 30%, and smaller accounts could be 50%. So it really just depends, where everything is. But I would say, Scott's right, 35 to 50, 55% of your capital, keeping it dry, that's good.
And I could say this for sure, because having done this for as long as we've been doing it, being on the customer-facing side of this, I can't tell you how many times I've seen people say, here's what I'm going to do. I'm waiting for the market to break, and the market breaks. And not only do they not, because their positions were a little larger than they thought, but they were making a lot of money. So they're like, I'm going to keep increasing. So now they're in a position where they're scrambling. Do I have to cover? Do I have to adjust? Not thinking about, hey, I thought that this might happen and I want to deploy more capital and put more short positions on. So you have to think about it in terms of not, wow, this strategy is working amazingly well, I want to be all in. It's what if it doesn't work? Because I don't care what your strategy is, you're going to have times when it doesn't work. And selling puts, as lucrative as it has been for the last 20 years, there have been some drawdowns. I'm thinking last April, that was a scary move. And if you had those on, what do? So you have to make sure that the concept that you have in your mind, you're actually able to execute it, because if you're over leveraged or you put too much risk on, you're not going to be able to do it. So just keep that in mind.
We've researched put selling strategies over the last, all the way back to the kind of the meltdown in 2008. And if you maintained 40% of your capital as not in use, in excess buying power, there was never a time when you got margin called out.
I'm not saying that you didn't get margin.
No, I'm just saying, I'm just giving you a number. 40% was the cutoff.
But you could be and here, there's a couple of other, okay, we'll leave it at that.
Yeah, I'm not saying you're wrong. I'm just saying that's the actual cutoff.
Yeah.
Apples and oranges.
They never came to your house knocking on your door. That's right.
Okay, should we go to market talk?
Yeah, let's go to market talk.
Amazing. So when we started, I think this is where SPOOs were. SPOOs are on 24. You got gold up 80, Nasdaq's down 80. Bitcoin's got a big bid.
It did catch a bid. It was up $300 this morning.
Yeah, it's up 3,400. So people are coming from Bitcoin. Oil has not moved. It's up $4. Silver's down $4. VIX futures up 60 cents, which is, if you were just at a 25-point down move, that would be a big move. Obviously, we're down, a lot more, and that's why it's still staying up here. VIX cash is up $1.73. I think it was up close to $3 at one point. Bonds are down a point. That's a big move for the bonds.
That's a really surprising move to me because
that's a big move.
They were up last night too. When they first opened, they were up. So the bonds being down a full point. I'm not a buyer yet, but I'm a buyer in the 116 handle.
A buyer or a 14-put seller?
No, I'm a buyer of bonds, or I'll be selling 15 puts in if they get into the 116 handle.
Nice. As Tom said, you've got Meta and Microsoft are up, Micron and Google are down, Nvidia's higher, Oracle's higher. So you kind of have a mixed bag. I think it's going to be interesting to see. Do we sit here the rest of the day? Do they rally? Are they up on the day, or do they go back down?
Well, already it's a disappointment as far as like those who thought we were going to be insane today. Like you thought there's going to be some kind of this crazy. I mean, listen, if anybody last night, you couldn't predict silver was going to be down $4 and gold's going to be up, 80? That's a crazy move. Somebody wrote me last night and they go, what do you think of the gold silver ratio here? And I go, what are you thinking of doing? They go, well, I mean, I don't know. Like, they're like, I just thinking of trading the spread. I'm like, well, I don't have it on right now, but
what is the spread?
I don't know. I would say the spread is going to be. I would say the spread is going to be in the 60s. I don't know where it is. Low 60s, maybe.
68, 65, minus.
I think low 60s. I'm not sure. It was traded 44. That's right. That was the low I was buying it at. I think it's back to 60. I don't know. I don't have a calculator right in front of me. But it's had a crazy move. Today is an insane move. Silver down $4 and gold up so much, up 80. Crazy.
It's crazy.
This is just a nutty move. I didn't see bonds down $1, and notes are actually higher. This is a really weird.
It's strange. It is. This is a strange day.
Yeah, strange day so far. I don't have any feel for it. I mean, I'm a little bit. I'm not short. I think I'm a little tiny bit long, but I don't think it's like I have crappy stocks. Like I have a bunch of quantum stocks I bought last week, which I have no idea how they're doing today. I think I'm still long some Robinhood, which I have no idea what that's doing today. I'm long Netflix. I think that's up small, but
Netflix is up 73 cents.
Yeah.
Was it up the other day so much because they backed
the deal's
out?
off. Yeah, they backed out. Everybody hated that deal. I mean, buying Warner Brothers is like the dumbest thing in the world.
And what they get? Almost $3 billion. They had to be paid. They got paid.
Oh, who knows? Something like that.
For the breakup, I think they got paid like $2.8 billion.
Well, what's crazy to me, what's really crazy to me, is that first of all, I don't understand what Larry Ellison's doing. I know he's like 85 years old, and he's probably like his brain's probably 3/4 away fried, but like, what's he doing? Like, you build databases, okay, and you became
he's trying to amass.
No, I understand, but I'm saying you build databases. You became one of the wealthiest people in the world. At one point, when Oracle opened at 350, you were the wealthiest person in the world. Now Oracle's lost 70% of its value. Where is it? 140, 145?
148.
Oh, so it's rallied a lot. To say it was a lot lower this morning. So let's say it's 148. So you've lost over almost 65% off your highs. Okay, you've lost over half your money, and then you're buying Paramount, and then you're buying, you're buying Warner Brothers. You're spending what, $75 billion? So half your money.
90 or 100.
Whatever. You're spending half your money.
Well, it's not his. I mean, they're getting people to put money up for this. He's not writing a check.
Who's putting money up?
I'm sure he's got financing for this. He's writing a check for $100 billion?
I don't know.
Doubt it.
I mean, would you give him money? I wouldn't.
No,
of course not.
There's nothing about that interests me.
Of course not. But what's the point of buying Warner? Like, what's the upside there? Like, what do you think you're going to do?
Well, I mean, you control with Warner Brothers or Paramount. He's got CBS, CNN, so he's got
Good luck.
Okay.
He wants to control the media.
I'm not saying I think it's a good purchase.
Because he wants to wash everybody's brain.
He's got a loud voice.
Why? I'm saying you're 85 years old. Why?
Who the hell knows?
Like that's your legacy? You want your legacy to be this? Like you had a chance of your legacy being you changed the world with the database that you built, the database technology. Everybody uses it. Now you want 60% of
the passion project.
Now you want 60% of the people in the world to hate you and leave your legacy as you're a douchebag. Like, I mean, come on, man. I mean, how stupid are you? Some of these people are just unbelievable. Anyway, on that note,
ciao
for now.
Ciao for
happy
now.
Monday.
Yeah, happy Monday. See you tomorrow.